Welcome to episode 8. That's the Ocho of This Week in the Metaverse. Yon is obviously back from vacation, so it's the two of us again. We're going to break down some pretty big news items from the world of the Metaverse. Probably most of you saw Unity buying ironSource for $4.4 billion, so we'll definitely dive into that first. We're also going to talk about Polygon, excuse me. We spoke with Ryan Wyatt on Into the Metaverse Season 2. Polygon being the only blockchain-based company selected into Disney's Accelerator program. That's quite interesting. And then lastly, we're going to talk about a new branded experience showing up on Roblox, which I thought is interesting. It's getting a lot of press, and it's supermodel Karlie Kloss launching a virtual series of virtual fashion pop-ups inside of existing Roblox experiences. So I think there's some interesting topics, and beyond just the actual news items, what it means for the metaverse more broadly, where we can add expertise and insight from our background. So, before we dive in, we just have a short announcement to share. All right, so we're going to dive into Unity ironSource. This is a big deal. This is a big deal in ad tech. This is a big deal in software. This is a big deal in the metaverse. Unity, for those that don't know, they have a real-time 3D engine. We spoke with Mark Witten, the head of the Create business, which oversees the engine, earlier this year. On Into the Metaverse, and he talked about just where they're going and bringing real-time 3D everywhere to enable the metaverse. But they really make money from ad tech, selling ads inside of games for game developers, helping them monetize their games better. And buying ironSource, which is really a mediation engine, which basically creates almost like a real-time auction for ads, for buyers and sellers for ads inside of games. That's really going to help juice up Unity's advertising stack and really help them double down on in-game advertising. Obviously, that's not necessarily the future for the metaverse. That's for the current business as it is today. There's a lot to break down. The stock was down a lot on this deal. Cathie Wood bought an extra 1 million shares after the stock fell. Yon, you want to have any initial thoughts, and then we can kind of just go from there?
Well, first, I would say that Cathie Wood is basically, continuing to buy the dip and buy the dip. It's pretty impressive, actually. She doesn't give up, and that's pretty amazing. So kudos to her. Look, I think that this is obviously not an acquisition about the future. This is an acquisition that gives Unity potentially a bit of peace of mind from the markets for the next few quarters. It's an acquisition that helps their core business with the advertising. It's an acquisition that pushes their EBITDA up. And so in that regard, short term might help Unity kind of go above the cloud. And even though the markets didn't seem to like the deal at all, what I think is disappointing with the deal and with the size of the deal of about $4 billion, even though it's an all equity deal, is the fact of how little it means for the longer term vision of what Unity wants to do as a quote unquote enabler of the metaverse. And so I think with that respect, it's really curious. And I'm very curious on what were the sort of executive leadership conversations that were happening inside Unity when they decided to make the acquisition, and the support of the board. The support of the board, obviously, because you also have Silver Lake and Sequoia that have backed with another $1 billion on top of at the end of the deal once it's closed. And so I think there is definitely a lot to digest here in terms of the trade-offs that Unity have made in making the deal. And then lastly, I would say for a company like ironSource, seems like the stock has gone down more than half from where it used to be on the SPAC listing, which was about $11 billion. And ironSource is a pretty strong player, and building on top of the platform that Unity has, it seems like this is a better deal for ironSource than it is necessarily for Unity in the long term.
And you saw that in the stock price as ironSource jumped 50% to the deal price, and Unity sank 17%, just to put some numbers behind it. And then I'll actually take the numbers that they talk about and put it into plain English for people that don't speak financialese. They talked about getting to $1 billion run rate of EBITDA in 2024. Think of EBITDA as like your cash profits before you pay taxes and interest and everything. And so a run rate means they're going to exit 2024. So think like $250 million of EBITDA in the fourth quarter of 2024 is basically what they're telling you they're looking to get to. They barely broke even in the first quarter of this year. So, that's a lot of profitability increase. And ironSource is a much more profitable company than Unity as it is today. So they are buying profitability. we talked about, and this was in the blog post that I wrote on the Substack, that companies that don't have a path to profitability, don't have a path to sustainable cash flow, are just getting slaughtered and going bankrupt and laying people off. Well, in that vein, buying profitability is a good thing, you can argue. A lot of that does come from what they call synergies, which they wouldn't elaborate on whether that's cost cuts or revenue synergies. Revenue synergies tend to be magic and don't actually ever happen. So realistically, it's going to come from cost cuts. So there's going to be overlapping functions, right? There's going to be overlapping technology, overlapping people, central functions, finance, all the costs of being a public company. Those go away. So that's $300 million, but there's still a big gap to get to $1 billion. And I think there's already people skeptical they're going to get there. So, there's a lot of onus on them to really execute, integrate, and do that well. And this is a management team that, up until late last year when they bought Weta for $1.6 billion and now ironSource for $4.4, they had done lots of little tuck-in deals, things like that. Now you're doing multi-billion-dollar M&A. Do they have the track record of integrating? And that's, if you look at someone like, I know it's mobile games, it's not ad tech, but Zynga, when Zynga started becoming an acquisition growth company, they did it, I think, the right way. They started small. They built out a systematic approach to integrating companies, integrating teams, integrating tech stacks, and then over time built that into a much, they were able to, increase the scale of what they did, deal after deal. Unity is just kind of going for broke with these big deals here. And, I don't know if this is the end of it. I mean, they could continue to be acquisitive, and there's a lot of risk in that. I mean, if it's successful, it's going to pay off nicely, but there's a lot of risk. The last thing I'll just note, from the financial market side that really kind of irks people is it goes back to what you were saying about, what's the metaverse thesis for Unity and how is that affected? If you looked at Unity as a SaaS company, software as a service, and you thought this is a business that's going to generate highly predictable cash flows over the next several years because of subscription revenue business, you're increasingly pivoting the financials of this away from subscription software now and towards a more, cyclical advertising business. And those types of businesses are valued much differently. And so alongside just the general market tanking, growth stocks tanking, now you have a real thesis shift as well. There's even some people that are saying, instead of buying more ad tech, they should have just punted the ad tech and been a pure software company. But here we are, they're doubling down on ad tech. And so that definitely changes the investment thesis for Unity. And then, as you mentioned, they also are selling $1 billion of converts. So not only is this an all-stock deal for ironSource, which is dilutive to existing shareholders, ironSource owners will own about a quarter of the combined company, selling $1 billion converts to shore up the balance sheet on top of that, with relatively, generous conversion strike prices, very good chance those actually convert to equity. So that's another $1 billion of dilution. So, they are also diluting the cap table, the existing equity holders. And if they don't execute on the financial plan, the $1 billion of EBITDA run rate, the cost synergies, this can end up, not being the best deal for existing shareholders.
Time will tell.
Time will tell. Now they got to execute, they got to integrate, and
as I like to say to my team, execution is the mother of success. So.
All right, we probably said enough words about this deal. I could go on for hours on this, but we can move on to the next topic of the day, which I think is actually really interesting. And, Matthew Ball, my boss now, was interviewed by Protocol, and he talked about Disney. They're not just sitting back and adopting third-party technologies to build the metaverse. They're actively developing technologies, standards even. The USD protocol came out of Pixar, which is part of Disney. And that's kind of like one of the foundational, protocols for 3D content on the internet now, or it will be in the metaverse, is what a lot of people are building towards. And so, we see that Polygon was the only blockchain-based company selected to Disney's annual Accelerator program. There's only 6 companies. 3 out of the 6 are Web3, but, Polygon's the only blockchain one. It's interesting that they're going to work together to develop augmented reality, NFT, and AI experiences. And just to throw it out there, the Polygon Matic token jumped 20% on this. So if you're a bag holder of the Matic token, like I have a, very, very small bag, but it's sitting there. So, a little bit of ground back, but, Yon, what do you make of Disney working with Polygon here?
Well, I think, first of all, I think it's a big win for Polygon because they are positioning themselves as essentially the gateway to build interactive experiences on blockchain, if it's games or other forms of interactive experiences. and they are positioning themselves also as that sort of app store kind of architecture for other people to come and build on top. And Ryan spoke about that in the podcast earlier this year when we hosted him as a guest. And so I think it's a big win for Polygon, and allowing them to build relationships with by far the greatest entertainment brand and company in the world, and also accessing numerous opportunities for NFTs and games that Disney may or may not want to work on. Needless to say, the size of the Disney catalog is massive. And so first, I would say massive win to Polygon. Huge congratulations to the team, because I really think this is going to continue and further position them as a consumer gateway to Web3 experiences, because of that sort of brand recognition. In terms of Disney, it is clearly a strategic decision for Disney to accept the Accelerator, an organization like Polygon, especially in today's world where there's so much backlash and uncertainty around Web3 and blockchain and crypto and so on and so forth. And this is probably both a great opportunity for them to be exposed and learn about blockchain and Web3 by having one of the biggest platforms as part of their accelerator. And the second thing is, I can see how later on, because Polygon is a platform and not necessarily building your own stuff, how that relationship between Disney and Polygon will provide many opportunities for Polygon to, quote unquote, provide added value to people who want to come in and build on their chain by having these type of associations like they are cementing with Disney.
Yeah, I fully agree. And I think one of the things that we need to keep in mind is that companies like Polygon, we talked about this with Mario from Roundhill about Solana building the software stack, is they're not just trying to make the price of the token go up. They're not just trying to power games. They want to build an economic infrastructure for experiences on blockchain, whether that's games, whether that's, financial applications, or whether that's entertainment applications. And so, being able to build entertainment experiences that live on a dApp store, distributed app store, right? And basically bring that to devices and consumers wherever they may be. There's a lot of power in that. And so not only do they get proof of concept experiences, but they learn, how they can make this an easier on-ramp for other companies down the road. I think that's going to be extremely valuable, because those that can figure out the ease of onboarding experiences to dApp stores will be the most successful in getting those to consumers on devices they have. I think there's a lot of people talking about, well, in crypto, you need to have a physical wallet. You need to have everything, isolated and separate and secure. That's great for now, but that's not going to drive mass adoption. Mass adoption has to be seamless. We've talked about this a lot. The reason the App Store is so easy to use is because you just scan your face and you spent money. And so being able to have a seamless transaction base across experiences is going to be extremely valuable. And so whoever can build that, whether it's Polygon, Solana, whoever gets there is going to do it because they've built the infrastructure, and then they have these proof of concept experiences that show that they know what they're doing and they can do it the best and most seamlessly.
I am fairly confident that it's just a matter of time in the next 12 months until we'll see a first Disney IP being launched on Polygon in some shape or form. I think it's now pretty clear that it's most likely going to happen. We'll see. I think now it's more what brand it is, what type of experience it is. But again, I think this is a great coup for Polygon.
If I'm going to put my bets on, it's going to be probably Star Wars.
Well,
just because I think it won't be a kid. I don't think it'll be a kid's IP, just for all the reasons that
it's most likely going to have to be something more like in the grown-ups. But yeah, either Star Wars or any of the superhero Marvel IP, yeah, exactly. Most likely from that. Likely not a Disney princesses or even a Pixar IP, which is much more family orientated.
Yeah. All right, so I think after that we'll dive into branded experiences on Roblox, which is, we could spend hours talking about the branding opportunity on Roblox itself, but this week, Karlie Kloss, who's a supermodel who I had never heard of until this was announced, but obviously I read up on it when it got announced. She has launched 5 pop-up stores across existing experiences on Roblox. It's a limited time event. There's some free items for people. There's some paid items. It's a little bit different than like the Gucci Town model where they build a persistent store and then you you spend time, you get stuff, you can buy stuff, etc. So curious your thoughts on this pop-up model versus the persistent model, like as from a branding perspective, and then also, just overall, where are we at in terms of brands trying to get onto platforms like Roblox?
Look, I think we're witnessing a growing institutional adoption of brands of the Roblox platform specifically. Generally speaking, in the category, but specifically with Roblox, I think we're seeing an amazing adoption of brands coming in and IP owners, mostly in the form of bespoke experiences being built. And of course, as a known disclosure at Super Social, that's big part of what we do is working with brands and bringing brands into the metaverse with a persistent presence on Roblox. But I think there is a legitimate approach to launching something like what Karlie Kloss has done, which is launching these pop-ups. And to answer your question on what is the difference, number one, a much lower investment in terms of development. To build a your own kind of bespoke brand world, your own game world, is a large investment that takes time. Of course, you control that, you own that, so that's the advantage. However, it is on the more expensive side of investment for a brand. Once you build pop-ups, or simply put, brand activations inside an existing game, you're operating in someone else's backyard and they own that backyard, but it allows you to experiment faster and more cheaply than building your own bespoke experience. And I suspect we're going to continue and see both approaches proliferating on the Roblox platform.
Yeah, I agree. I mean, and we talked about this in an upcoming episode with Jonathan from Activision, but I think there's a lot of people that are still wondering what the return on these investments is. Like, okay, we can see that Gucci Town had 28 million visits as of a couple days ago. I have to update the numbers, and like 8.5 million unique visits because you can look at badges. But what does that translate into brand value, into sales, whether it's virtual items or whether it's people actually buying real stuff in the real world? And so I don't know if we have the answer to like what the value of this investment is yet. I think there's enough people, clearly there's enough demand for these experiences, and the amount of people that are visiting them, the amount of recurring visits you're seeing, and the sales of virtual items to say there's something here that we should invest in. But, we talked about this with Kathy Hackle very early on in season 1 of our podcast, where, there's a range of outcomes that companies can do. There's a range of risk you can take, but you should be doing something. You should at least be evaluating the options in front of you and having a metaverse strategy if you're a brand, whether that is selling, just, creating virtual items to sell in the marketplace, creating a pop-up store inside of someone's experience, or making your own. You should be evaluating these and thinking about how you want to reshape your brand as the metaverse takes shape, specifically in a platform like Roblox.
Yeah, and I think this is definitely a great argument, Matthew. And I would add that we are at the very early stage of this adoption. I think the stage we're at the moment with branded experiences on Roblox is very much like the beginning of opening a Facebook page on Facebook for brands, about a decade and a half ago. And I think it's going to take time for those quote unquote pages to evolve in complexity and performance. And it will take time to really being able to measure effectively what does it mean for the brand. And I think at the moment it's clearly coming out of the marketing budget. It could well evolve into other departments in corporations in the future. But I think that's going to take time, and I think that's totally normal.
I agree, and then I'm curious eventually how how we link these virtual experiences with the physical world. I think Nike, what they've done buying Artifact, we talked about that a while ago, but potential for them to do like virtual and physical sneaker drops at the same time, is something that I'm really curious to see what that looks like, but also excited about. And so I think there's a lot of opportunities for these experiences to go beyond just games, things that you can play in, things where you can buy virtual things. They can literally become virtual storefronts, virtual shopping malls, particularly as augmented reality and other technology catches up. This will evolve into something much more than it is today. And so, as you said, we're only scratching the surface of the potential of what's here.
And they're more than welcome to reach out and come and have a chat with me. Happy to talk about all of that and explore.
I think that's a great place to wrap up. Thanks. And this was a great episode of This Week in the Metaverse, and we have more great content coming your way.